Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Nebius Group.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and before we really get going, we want to mention StockOracle. We've got a special 14-day trial link right down below in the description for you guys.
Exactly. And just to be totally upfront, that is an affiliate link. So the channel may earn a commission if you use it, but it comes at absolutely no extra cost to you.
Right, and StockOracle is this really powerful AI-aided stock research platform. But we have to remind you, it is not financial advice.
Yeah, definitely not.
It's not a trading signal service.
Yeah.
And it doesn't provide real-time market data.
Right, and obviously AI insights and valuation estimates can sometimes be incomplete or just flat out wrong. So you always have to verify the important facts yourself. We are not telling you to buy, sell, or hold anything today. We're just looking at the data.
Yep, just breaking it down so you can make your own decisions.
All right, so let's get into it, because honestly, if you logged into your brokerage account on, say, a random Tuesday morning, and you pulled up Nebius Group.
Oh man, what a chart.
Right, I mean, you look at the company, and they just reported this staggering 684% year-over-year revenue increase.
Which is just wild for a physical infrastructure play.
Totally. And you comb through the data, and you see they are sitting on this almost incomprehensible $50 billion backlog of contracts.
50 billion. Where'd it be?
With the biggest tech companies on Earth. So by every traditional metric, this business is an absolute juggernaut. But then you actually look at the stock chart.
And your stomach just completely drops.
Exactly. Because the stock violently plunged, like 33% in a matter of days. And you start searching for news of a scandal or, I don't know, a bankruptcy.
The massive failure, right? You think something had to have broken.
But you find absolutely nothing. And then you watch the ticker right before your eyes, and it suddenly whipsaws into this massive 27% single-day surge.
It completely defies standard financial gravity. I mean, when you see that level of aggressive dislocation between a company's fundamental business and its stock price, something is happening.
Right, there's something huge under the surface.
Exactly. It tells you that there is this high-stakes tug-of-war going on between massive institutional whales and just chaotic market volatility.
So that brings us to the wealth-building context of our analysis today. Because if you want to understand where the global economy is heading, you have to look at the AI cloud infrastructure boom.
Yeah, you have to look past the software.
Right. The AI revolution isn't just like lines of code floating in the ether.
No, it's steel. It is miles of copper and fiber optic cable. It's liquid cooling systems. It's literally billions of dollars in physical capital expenditure.
And Nebius is essentially selling the picks and shovels for this gold rush. So let's look at their fundamentals, because their Q1 2025 numbers are genuinely hard to process.
They really are.
They reported $399 million in revenue, which completely shattered expectations. But the more interesting metric to me is their annualized run rate, their ARR.
Yeah, the ARR is the absolute pulse of this entire operation.
Yeah.
They closed Q1 with an ARR of $249 million.
Okay.
But then, just 1 month later, in April, that number had already accelerated to $310 million.
Wait, they added over $60 million to their run rate in a few weeks.
Yes. They are officially pacing toward a $1 billion run rate for the year. That specific jump shows that market demand for compute power isn't linear.
It's just going completely vertical.
Exactly. And we are seeing this flow through to the bottom line, too. They reported an earnings per share loss of 23 cents.
Which, I mean, it is still a loss. But looking at the estimates, analysts were actually bracing for an 81-cent loss.
Right, so they're scaling toward profitability at a speed that traditional financial models are just struggling to map out.
But I want to stop and look at the physical reality of that growth, though, because building an AI data center is not like renting a server closet in an office building.
Oh, not at all. You are essentially building a small, incredibly power-hungry city.
Right. You have to buy the real estate, get dedicated power grids, industrial cooling, and then you pack the buildings with tens of thousands of GPUs.
And those GPUs cost as much as luxury sports cars.
Yeah. So if they are building these global data centers at this breakneck pace, the cash burn has to be astronomical. How are they paying for this without going bankrupt?
So this is the central tension of the whole AI infrastructure industry. Capital efficiency. To understand how Nebius is surviving this hypergrowth, you have to look at their debt structure.
Okay, what did they do?
They recently secured a $775 million senior secured debt facility It matures in October 2030, and the pricing is set at SOFR plus 2.50%.
Okay, we need to translate that for a second. So SOFR, the secured overnight financing rate, that's a floating interest rate.
Yep, it's variable.
In this macro environment where interest rates have been wild, taking on hundreds of millions in variable rate debt seems like a massive gamble.
It is a calculated risk, definitely. But the truly fascinating part of this debt facility isn't actually the interest rate. It's the collateral.
What do you mean?
Well, historically, if you want a loan of that size, banks demand hard, appreciating assets, like prime real estate or a manufacturing plant.
Sure.
But Nebius is doing something entirely different. This debt is asset-backed by their deployed GPU infrastructure and their contracted cash flows.
Wait, but GPUs are depreciating tech hardware. An NVIDIA chip is amazing today, but in 3 years it's going to be obsolete.
Exactly.
So why would major banks accept depreciating silicon as collateral for nearly $1 billion?
Because the banks aren't looking at the physical metal. They're looking at the ironclad contracts tied to that metal.
Oh, I see.
Yeah, these GPUs are locked into long-term lease agreements with some of the most credit-worthy companies on Earth. The cash flows are guaranteed.
So the demand to lend them this money was probably massive.
It was heavily oversubscribed. And this specific financial engineering lets Nebius cover over 100% of their GPU capital expenditure with debt.
Meaning they don't have to drain their own cash reserves to buy the hardware.
Right. They can maintain a trailing 12-month net margin of over 93%, aggressively reinvesting every free dollar right back into the ground.
Okay, so that explains the financing fundamentals. But that forces us to look at the catalysts. We know how they are paying for the servers, but why are clients flocking to Nebius to rent them?
That's the billion-dollar question.
Right, because we are talking about massive tech companies as their primary customers. Why wouldn't a tech giant just use legacy cloud providers like Amazon Web Services or Google Cloud?
Well, the answer is in the fundamental difference between standard computing and artificial intelligence training.
Okay, break that down for me.
Generalist cloud providers like Amazon or Microsoft, they spent the last 15 years building architectures optimized for CPU workloads.
And CPUs handle lots of small independent tasks, right?
Exactly. Think about hosting a million different e-commerce websites or database queries. But AI doesn't work like that.
It needs parallel processing.
Right. Training a large language model requires massive clusters of GPUs working together.
Let me see if I have this analogy right. A traditional CPU cloud is like having one incredibly fast master chef in a kitchen. They cook one meal at a time, super fast.
Perfect analogy, yeah.
But GPU computing, what AI needs, is like having 10,000 cooks in a massive kitchen, all chopping vegetables for a single gigantic banquet.
That is exactly it. But the problem isn't just having 10,000 cooks. It's that those cooks have to constantly talk to each other in real time.
At the exact same millisecond.
Right. If there is a delay in communication between cook number 4 and cook number 9,000, the entire AI training run stalls.
So if you try to run that 10,000 cook operation inside a kitchen designed for the single master chef,
the communication completely breaks down, the latency becomes crippling, legacy clouds are trying to retrofit old infrastructure for these new GPU clusters, and it's terribly inefficient.
But Nebius is vertically integrated from the ground up for this.
Exactly. They don't just buy off-the-shelf servers. Their engineering team actually designs their own server racks. They engineer specific liquid cooling mechanisms.
Wow, so they are building the specialized kitchen specifically for the 10,000 cooks.
And this bespoke engineering has allowed them to forge a very unique partnership with NVIDIA. They are an integral partner assisting NVIDIA in rolling out the new Blackwell GPUs globally.
So when you design a data center that perfectly harmonizes with NVIDIA's flagship hardware, you create a massive competitive moat.
Huge moat. Because once an AI developer writes their code on Nebius's highly optimized architecture, the switching costs are astronomical. You can't just drop that model onto Amazon without massive friction.
Which brings us to the backlog. Because the passengers paying to use this system are huge. We are looking at nearly $50 billion in locked-in revenue.
The breakdown of that $50 billion is a who's who of tech. You have a $2 billion direct investment from NVIDIA, a 5-year contract with Meta for up to $27 billion in AI cloud capacity, and arguably the most fascinating, a $19.4 billion deal with Microsoft.
Wait, pause on Microsoft. They own Azure. They are one of the big 3 generalist cloud providers on Earth. Why would they hand nearly $20 billion to a specialized competitor?
Because the AI arms race is moving faster than Microsoft can pour concrete. They are desperate for specialized compute power to train their next-generation models.
They literally can't build it fast enough internally.
No, they are experiencing compute starvation. And Nebius has the exact bespoke infrastructure they need already spinning and ready to go.
Okay, so that's the catalyst side. The demand is crazy. But let's look at the technicals and the sentiment, because this is where things get really messy.
Oh yeah, this is where the stock chart comes in.
Right. Nebius is trading at a price-to-sales multiple of roughly 42.5. In any standard market, a multiple of 42 is dangerously high. It means the stock is priced for flawless perfection.
It is a screaming premium, without question. If this was a software company, it would be a massive red flag.
So doesn't a valuation that high leave the stock vulnerable to exactly the massive correction we saw, that 33% plunge?
Well, the market isn't praising Nebius based on current sales. They are pricing in the absolute certainty of that $50 billion backlog. But yes, that high multiple makes the technical action extremely volatile.
So let's dissect that drop. We watched the stock drop roughly 33% over 5 days from overbought levels, only to stage a 27% intraday recovery.
The trading volume during that drop was intense too, like 1.3 times the average.
And when I see a tech stock take a 33% hit on high volume, I assume smart money is fleeing, especially because company insiders sold over 1.1 million shares in the last 90 days.
Yeah, that insider selling is definitely a sentiment flag you have to watch.
Right. If the 50 billion backlog is a sure thing, why are executives cashing out?
Insider selling should always be scrutinized. But you have to contextualize those shares against the massive institutional repositioning on the buy side.
You mean the funds buying the dip?
Exactly. The volume surge wasn't just retail panic. Large funds used the drop to build generational positions, like Leopold Aschenbrenner's fund disclosing a $2.6 billion stake in Nebius.
But wait, didn't that same fund also offload a $16 billion equity portfolio during this period?
They did.
If the AI thesis is bulletproof, why dump $16 billion worth of shares?
Funds that size routinely have to rebalance to meet liquidity requirements or risk parameters. It doesn't mean their thesis is broken, but the mechanics of how they offloaded it explains the stock's wild recovery.
Because they didn't just dump it on the open market, right?
Right. If you dump that volume on the retail market, algorithms detect the sell pressure, stop losses trigger, and the stock goes into a free fall.
A total fire sale.
Exactly.
Yeah.
Instead, they executed a block trade with Citadel. Citadel stepped in as a market maker and absorbed that massive portfolio directly off the open exchange.
They basically provided a concrete floor under the stock.
Yes. And once the broader market realized Citadel had stabilized the floor, opportunistic buyers rushed back in. That aggressive buying sparked the 27% bounce.
Okay, so that explains the technical whipsaw. But let's move to the risks, the real bear case for the business. Beyond the rocky chart, what could actually break the Nebius thesis?
The biggest long-term threat isn't a direct competitor like CoreWeave. The biggest threat is their own customer base.
The hyperscalers, Microsoft and Meta.
Exactly. The chatter is that Meta might spend upwards of $62 billion on specialized providers, but the fear is that they are only renting this capacity as a stopgap.
Oh, I see. So they are renting the specialized kitchen right now just so their engineers can walk around, take photos of the floor plan, and learn how to build it themselves.
That is the ultimate bear case. The economics dictate that a multi-trillion-dollar company wants to own their infrastructure, not rent it.
So Nebius is basically being paid to train their future replacements.
Potentially. But the mitigating factor is the sheer agonizing difficulty of the task. Transitioning a massive legacy operation to replicate a highly specialized GPU infrastructure is incredibly hard.
Right. It's like a company that builds massive container ships suddenly deciding they are going to manufacture custom Formula One cars.
Great way to put it. They have the steel and the capital, but the engineering culture is entirely different. And while they spend 5 years figuring out aerodynamics, Nebius is cashing checks and locking in contracts.
Okay, so given these massive forces, the insider selling, the premium valuation, the threat of customers becoming rivals, what is our final verdict here?
Well, looking at the catalysts, the most immediate thing to watch is their Q2 earnings around August 7th. You want to see if they hit that full-year ARR guidance of up to $1 billion.
Because ARR proves operational execution. It shows they are turning that $50 billion backlog into actual reality.
Exactly. And macro-wise, you have Microsoft, Amazon, and Alphabet guiding toward a collective capital expenditure of $260 billion in 2025 alone.
Which is just a historic reallocation of capital. the global environment is demanding this compute power.
Absolutely.
So to wrap up the upside and downside for you guys, the upside is they are the premier vertically integrated pick and shovel seller in this AI gold rush, sitting on $50 billion in guaranteed contracts.
And the downside is a sky-high valuation multiple, heavy insider selling, and the long-term risk that their massive clients eventually figure out how to do it in-house.
So on a bullish score, balancing that extreme growth against the heavy volatility and hyperscaler risks, we're looking at a highly bullish but volatile rating, like 8 out of 10 if you can stomach the wild price swings.
I'd agree with that. It's a high-risk, high-reward entity armed with an elite moat.
But I want to leave you with a long-term view to ponder. If companies like Nebius build out this global infrastructure perfectly, what happens in 10 years?
When the grid is finished.
Right. Right now, AI compute is a rare, highly profitable commodity. But eventually, will it just become a cheap, ubiquitous utility?
Like water or electricity.
Exactly. And how does a company with a 42 multiple today pivot to survive when AI compute power is as cheap and invisible as the electricity running through your walls?
The reward for building the foundations of the future is that eventually you just become part of the plumbing.
Something to think about the next time you look at a crazy stock chart. If you enjoyed this analysis, don't forget to subscribe, like, and comment below.
And remember to check out that 14-day trial for StockOracle in the description. It's a great AI-aided tool to help you dig into these exact kinds of fundamentals.
Thanks for listening, and we'll see you on the next one.